Mr. Rana Gupta, who's the Senior Portfolio Manager, India Equity Specialist at Manulife Investment Managers. Welcome, sir, on the newsroom. Thanks for doing this. Let me first take it let me kick this conversation off by trying and understanding the context from you. Interest rates are largely a function of how markets are valued, right? And interest rates have gone up quite significantly. So while we are very close to our 10-year averages when it comes to Indian market valuations, but with that adjusted interest rate where the 10-year bond yield is now at 4.5%, the US 10-year, how do you look at valuations in this context? Should one look and adjust for those, or are you believing that the larger valuation picture is looking decent?
Look, interest rates are set by demand and supply of money, and of course, the central banks can influence and also set those interest rates. But I think broadly your question is about whether with the global interest rates going up and Indian stock market trading about 10-year of the average valuation, should we reset the valuation benchmark in the light of higher global interest rates? To that, I think what we would highlight is a few things. The interest rates globally, particularly US, is going up due to high inflation. High inflation is happening because, in our view, US has given a lot of fiscal stimulus, and they are creating a whole supply side into their economy. And at the moment, the demand is still resilient, and the supply of labor and other things are a bit constrained. That is leading to a higher than expected inflation, and therefore the higher interest rates. Now, that's why the interest rates are high. So one can focus on the interest rates and argue technically that the valuation should not be too high, but that's one aspect. I wanted to bring in another aspect to it. Because of the fiscal spending in US to set up, whether it is Inflation Reduction Act, whether it's CHIPS Act, setting up electric vehicles, manufacturing facilities, moving some productions near shore within US or other areas, that is also causing a huge demand. That's why in US, despite higher interest rate, US current account deficit is still expanding, which means US is consuming more. So I think it makes sense if you in the emerging market, if the country or the sector of the stock is influenced by US fiscal deficit in a way positively, I think in that case it makes sense that the stock is trading, those stocks are trading at average or even higher valuation. If not, if a company is trading at just a higher valuation with no linkage to US whatsoever, not benefiting from the fiscal stimulus in US, then I think there is a question mark. Closer home within India, I think also there is one point I wanted to make. Closer home, I think over last 10 years, a lot of reforms have happened, which is basically pivoting the economy from a higher deficit to now moving to much higher savings economy. From more consumption incentives to more investment incentives. So even domestically, the companies who are linked to those themes, there I think a higher or average PE is all right. But if a company is not, or sector not linked to those tailwinds and still trading at higher PE in this high interest rate environment, I think in that case, there is a fair amount of caution that will come in.
Right. So let me try and be more specific here. What would those sectors be where you would be cautious? Of course, clearly IT would be one of those sectors, where you would feel that there is some amount of caution. Also, export side retail, anything else that you believe would fit the first basket?
The first basket, as in you are referring to the sectors where we want to be cautious of because of valuation in the context of higher rates. Yes, I think the IT services, India IT services companies would put them in that box. Also, Indian IT services companies over even a medium term, their revenues can get impacted a bit by the artificial intelligence and generative artificial intelligence. Also, I think the consumer staples companies, they will continue to grow the way they have grown. Even in India, the per capita income grows. When the per capita income grows, people are not going to consume that additional, oil and soap and all those things. They will move to the higher ticket and discretionary items. So I don't see their revenue accelerating from the current levels. At the same time, over last decade or so, these consumer staples companies went from a 30-35 PE to probably 50-55 PE because of certain reasons that existed in the last decade. I think those sectors would be at risk because you don't see meaningful change in the earning trajectory. And the reason why the valuations went up so much are reversing. So I think Indian IT services and consumer staples are two sectors which we can put in that bracket.
Makes a lot of sense. And what about where are you finding valuations reasonable at this point of time? Of course, you said domestic facing sectors, but could you try and break that down for us, because you did put consumer staples in the first basket?
Sure. I think so. Now I think the basically we're asking that the sectors where we can get in line or even a bit higher valuation because they're positively linked to the whether global or even domestic for policy, fiscal or industrial tailwind. In that bracket, we will start with, let's look at what has happened in India over the last 10 years. India has become more digital, more formal, and government, because they could have high revenues, they invest in physical infrastructure, and then they gave incentive for domestic production. That in turn again lowering current account deficit. First of all, at a country level, this kind of milieu builds a very strong and sustainable growth for future growth. So Indian markets valuation is something comfortable. That's the first point. Now moving to which sectors that specifically benefits from this. Now let's look at digital economy first. I think that some of the digital platforms, particularly something like food services or online insurance and all those things, these companies have invested a lot in the platform. And when the growth comes, which is going to come in our view next 2 to 3 years, I think we think the cash flows in these companies will surprise on the upside. So I think that will be one sector. Second, I also mentioned in opening remarks that US is doing a fiscal stimulus. US is also rejigging its industrial policy. Basically, globally, the supply chains are getting reimagined. So Indian companies which are manufacturing, let's say auto ancillary, chemicals, they're in a place where they can gain global market share of exports. So I think that is one area which is attractive to us. Staying with manufacturing, even the Indian government, where Indian government is a big buyer, things like railways, defense, a lot of domestic production is happening. So I think that is also a positive. Last but not the least, staying with manufacturing, in India and all over the world, also in India now we are seeing the same trends, whether it's a mobile phone, whether it's a car or white goods at home, each has more and more content. Previously, everything used to get imported, but now the conscious policy push from the government side to make those more of content in India. So companies linked to those sector also benefit. So manufacturing, which will probably classify as industrial capital goods, is another sector we like. Then moving on, I think this kind of growth that we're talking about, sustainable, scalable growth that we began by talking about, that kind of growth is not possible without energy.
Sure.
And India depends on fossil fuel, right?
Right.
So in order for the growth to be truly sustainable, a shift to renewable energy is required. So we are again very happy to see that a lot of shifts happening towards that, and which is opening up a lot of investment opportunities in infrastructure and utility space, particularly the renewable energy space.
Right, and I'll try and punch this question real quick. Let me try and understand your view on cyclicals. Oil has been, of course, in focus of late, but what about some of the other commodity names as well? How do you look at the commodities basket?
Right. The view is that oil is, it's, of course, is a very hard one to predict because there is a supply side, OPEC, and what they will do next or not is very, very hard to predict. But it's still our best case is that oil kind of remains over this 90-100, and that's what best case we're going with. But I think if you are looking for a bit of a more medium-term view, we quite like the non-ferrous space, because given the transition happening in the global economy, more towards the renewable space, more to electric vehicle space, that is quite positive for copper and aluminum. And we think over a medium term, in the short term, there could be various headwinds from China or lack of it depending on the policies. But I think medium term picture for the non-ferrous looks quite constructive.
Right. Thank you so much for that. That was, of course, Rana Gupta and his views with regard to the market. Thank you so much, sir, for taking our time and giving our viewers that perspective.